What's up, everybody, and welcome back to the Wolf's Trading Secrets channel, where we help you build long-term wealth. Today, we're diving into essential tips and secrets to navigate the market and invest like a pro. Make sure to stick around until the end for a bonus tip that could save you thousands. And hey, hit that subscribe button and ring the notification bell so you don't miss out on any future videos. Alright, let's kick things off with tip number 1. Only invest in what you understand. You'd be surprised how many people jump into complex investments without really grasping what they're putting their money into. One of my favorite quotes about investing comes from Warren Buffett. Only buy something that you'd be perfectly happy to hold if the market shut down for 10 years. When you invest in something you understand, it takes the emotion out of investing. You're not going to panic sell every time the market dips because you know the underlying value of what you own. Think about it this way. If you were suddenly forced to hold on to an investment for the next 5 to 10 years, would you be comfortable with that? Remember, knowledge is power, especially when it comes to your hard-earned cash. So before you even think about buying a stock, take the time to do your research. Make informed decisions based on your own understanding. Now let's talk about another legendary investor, Peter Lynch. He ran Fidelity's flagship mutual fund back in 80s and 90s, the Magellan Fund, and consistently beat the market. In his book, One Up on Wall Street, he shared one of his most powerful investing secrets. Invest in companies where you've used the product. When you use a product or service regularly, you have first-hand experience with it. This kind of insight is invaluable and can give you a serious edge in the market. Of course, this doesn't mean you should blindly invest in every company whose products you use. You still need to do your due diligence and look at the financials. But having that first-hand experience can give you a huge advantage when it comes to making informed investment decisions. So, let's talk about the future relevance test. Will they matter in 5 years? Before you go all in on a stock, ask yourself, in 5 years, will this company and their products be more relevant or less relevant than they are today? The stock market is forward-looking and cares about future growth potential. Will this company be able to adapt to changing consumer preferences? Are they investing in new technologies and innovation? If you have even the slightest doubt about a company's future relevance, it's best to steer clear. The market is full of opportunities. You don't need to settle for companies that are past their prime. For example, years ago, you might have wanted to buy Yahoo's stock because it was cheap versus Google. Well, if you asked yourself years ago, would you be using Google or Yahoo more often in search in 5 years, what would your answer have been? Of course, the answer would have been Google. We all know how that story played out. Google's innovative search engine and suite of products quickly eclipsed Yahoo, and their stock reflected that growth. Yahoo failed to adapt and innovate, and their stock price stagnated. This is why the future relevance test is so important. Another example is BlackBerry versus iPhone, another lesson in future relevance. Back in the day, BlackBerry was the king of smartphones. But then, in 2007, Apple launched the iPhone, and the rest, as they say, is history. Imagine you were an investor back then. You could have bought BlackBerry stock, which might have seemed like a safe bet at the time. But if you had applied the future relevance test, you might have had second thoughts. After experiencing the iPhone or the early Android devices, did you think you'd be using a BlackBerry in 5 years? The answer for most people was a resounding no. The iPhone's touchscreen interface, app ecosystem, and overall user experience were simply light years ahead. BlackBerry failed to adapt to the changing smartphone landscape, and their stock price plummeted. Apple, on the other hand, became the most valuable company in the world. The lesson here is clear. Don't be afraid to bet on innovation, even if it means going against the current market darlings. So there you have it, my friends. Some of my top stock market secrets to help you invest like a pro. By following these simple tips, investing in what you understand, considering future relevance, and doing your research, you can make smarter investment decisions and put yourself on the path to financial freedom. Now, I promised you a bonus tip, and here it is. Don't be afraid to start small. Thanks to fractional shares, you can invest in even the most expensive companies with just a few bucks. The important thing is to start investing early and consistently. If you found these tips helpful, make sure to subscribe to the channel for more investing insights and secrets. Until next time, happy investing.